also adding radiation facility at Agartala. Have you bought the LINAC machine, or what process, where are we at, and what is the cost, if at all?
We are starting radiation oncology facilities in Agartala. We've already started medical and surgical oncology in that hospital. The radiation oncology piece, the equipments are being bought by our cancer care partners, CVCC USA, and we are hopeful of starting that in the next 3 months.
Okay.
The AERB approval has already come in, and we've already created the facilities in terms of the bunker and the OPD setup.
Perfect. And what kind of cost are you going to be incurring on this?
Most of the cost from our end towards this has already been incurred. The balance cost is to be incurred from a partner's end.
Perfect. That's it from my side. Thank you.
Thank you. The next question is from the line of Himanshu Binani from Anand Rathi. Please go ahead.
Hi, sir. Thank you for taking my question. So, sir, my first question was largely on this Raipur facility. So, we intend to do a capex of somewhere around 55 crore for 152 beds. And in our opening remarks, we commented that we would be looking to take some sort of debt for the medical equipments also. So, sir, this debt number is already included in the 55 crore, or this is over and above that?
So that number is already included in the projection of 55 crores, which we have highlighted.
Okay, and the debt number would be approximately out of that 55 crore?
It would be around the 10 to 15 crore mark.
10 to 15 crore sort of number. Okay. So the second question was largely on this only, with the first question only. So if I actually work out with the maths, so for the Raipur facility, we would be doing a capex of somewhere around 36 lakh rupees sort of number for 152 beds. And for Ranchi, we would be doing somewhere around 36 lakh rupees.
Correct.
So how should actually one look into the capex per bed basically? So why this number is so low, or?
So if you look at the capex per bed for our latest full-fledged hospital of Howrah, it is almost 7 million per bed. Here it is 3.5 million per bed because these two hospitals are on an asset-light model. Howrah was completely built and owned by us. Here, the land and the building will be owned by the developer, and we will be operating it on a long-term lease of around 40 years and 60 years respectively.
40 to 60 years. And the annual escalation for this would be the rent escalation?
There is no annual escalation. The escalation is on a 3-year period, and it ranges between 7 to 8%, depending on the nature on the hospital, which would translate to a CAGR of around 2%.
Got it. And sir, the second question is largely on this break-even price. So we have been talking about this break-even for Howrah as well as other hospitals, and we have done a remarkable thing. So how should one look into this Raipur hospital for break-even? So maybe I'll just put it this way, sir. How do we actually calculate the break-even? So what is the number, the ARPOB number do we start with for a new facility?
So in terms of break-even, we are envisioning a break-even period of around 12 to 15 months for the Raipur facility, which is higher compared to our break-even for our Howrah facility. This is because we are mindful that we are going to a new area, and there might be a certain delay on account of that. Most tertiary care hospitals, which are our peers, tend to take almost 2.5, 3 years to come to this monthly break-even period. In terms of what metrics we follow to account for the break-even, we generally, as per industry norms, we look at a 35% occupancy, generally translates to break-even. Here we will be starting off with our ARPOBs of around the 27,000-28,000 mark at current levels, which would be inflation adjusted for when we commission the hospital. The prevalent market in that area is as per that ARPOB, and we would be matching that.
Got it. Thank you.
Thank you. A reminder to all participants, ladies and gentlemen, you may press star and one to ask a question. Our next question is from the line of Dishant Jain from Quasar Capital. Please go ahead.
Yeah, thanks, sir, for the follow-up. Can you please help me why this London hospital occupancy has been reduced on a 9-month basis, sir, like from FY23 to 9 months FY24? Is it due to the seasonal factor or?
So, as I said earlier, any occupancy above the 75% mark is optimal occupancy. 78% occupancy, which we are doing in Damnam, is a very good occupancy. Last year, if you're looking at a differential between last year, it is slightly to do with the bed infrastructure also in place. Last year, Durga Puja was slightly earlier, and this year it is slightly late. So we are going to see that impact coming in Q4 as well. And also, it translates to the bed preference people might have while getting operated as well.
Okay, thank you. That's it. Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and one to ask a question. The next question is from the line of Chintan Shah from JM Financial. Please go ahead.
Hi, thank you so much for the follow-up. So just one question in terms of thought process and strategy. So if we look at our existing hospitals as well as new hospitals that are coming in, we optimally utilize the bed capacity, meaning we don't have any scope for further expansion. So wanted to understand why as a strategy we go for this. The reason why I ask this is because if you look at a hospital, if we have additional capacity, brownfield in the same locality, etc., it's the easiest way to bank it, especially when we are in a region which is quite underpenetrated. So can you just help us understand this thought process behind this?
So, thank you for the follow-up question. Ideally, we would also be very happy if we would be able to get that brownfield expansion capacity in these areas. But unfortunately, we place our hospitals in some of the most densely populated parts of the city, where getting that kind of real estate on an additional basis is very difficult. Getting 1 lakh square feet or something to the tune of that in these thickly populated areas is very difficult. And whenever we do end up getting that area, we tend to utilize it to the full to place our hospital. After that, the possibility of expanding is very less.
Got it, understood. But if we look at our peers, I mean, there are quite a few already present in this region, and they have much larger capacity, say at 300 or 400 beds. So I mean, if they are able to, have that much capacity, then I mean, where is the bottleneck for us to not, get the land or building piece available?
So yes, there are larger peers available in the region where we operate in, but it is in the region where we operate in, not in the micro market. The cities are big and the cities have various areas. So most of the larger hospitals are slightly away from the city in the lesser populated areas, while our hospitals are right in the heart of the city in those thickly populated areas.
Okay, got it. Understood. So in that case, if there's such a micro market where there is limited competition, then ideally we should have a much better pricing power, say in terms of ARPOB or the mix. So we think in terms of basically specialties, there is some element where we lack, or how should we understand this? Or is the capacity of the region to pay?
So again, we place our hospitals in these micro markets, which are mostly full of working class population, of middle income population. In these regions, we do not want to outprice ourselves to the extent that patients do not end up coming. If the pricing is very high, patients will look at other options. Our pricing, we feel, is just right for that region, and which enables us to operate in a good manner.
Okay, got it. Understood. And lastly, in terms of, occupancy, is there any scope for us to, go for more insurance tie-up and drive the occupancy growth, or would prefer more of the cash patients?
So in terms of our current payer mix, if you see, almost 91% of our revenues come from cash and insurance patients. with corporate schemes and government contributing only 8 to 9% of our revenues. We feel this is a very healthy mix, which gives us almost 80% cash flow from operations to EBITDA conversion, which is one of the highest in the industry. We are always obviously looking at increasing the cash and insurance mix even more, but at this point, I think we have saturated in terms of what is available in the market. We have tied up with all insurance companies and TPAs, and we are catering to all of them.
Okay, got it. Understood. That's it from my side. Thank you so much for answering all the questions.
Thank you.
Thank you. The next question is from the line of Sanchit Chawla from Shubhkam Ventures. Please go ahead.
Sir, I just had one follow-up. Wanted to understand why your ARPOBs will grow only by 7-8% if you're adding onco radiation facility at Agartala. Because addition of this will kind of give you a significant increase in ARPOB. Hello.
The onco radiation facility is in partnership with someone where there will be a revenue sharing with us. Apart from that, we are mindful of the cost incurred by the patients, and it's a conscious call to not load up the ARPOB in a big way for the patients. We will be getting significant advantage in inpatient occupancy on account of the onco, which will end up impacting the ARPOB to that extent as well.
Okay, got it. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Divya from Master Trust. Please go ahead.
Hi, sir. Firstly, what are currently, what risks do you see in your business? And recently, the Supreme Court order on CGHS, does that impact your business?
So, in terms of the risk to the business, obviously we are in a micro market. It's a regulated industry, so we need to keep the doctors engaged, the patient service to be up to the mark, so that the patients are loyal to the hospital in their neighborhoods. In terms of the Supreme Court, I would say that, like Anurag said earlier, we are in talks with the hospital association as well as the government departments to ensure that it's a smooth transition and there's no abrupt intervention in the hospital industry. We don't anticipate it to be a very big impact, but we'll have to wait and watch.
Okay. And so is there any cyclicity in your business, as in this quarter is better than other quarter?
Yeah, so like we said earlier, Q3 is generally a seasonally weak quarter. Other quarters are almost, Q1 is also slightly, maybe a slight dip, but generally Q2 and Q4 are the better quarters.
Q3 and Q4?
Q3 and Q1.
Q3 and Q1, okay.
And Q2 and Q4 are better.
Okay, got it. And so lastly, sir, what's your, as a management, so what's your aspiration for the company?
So, we want to be an Eastern India focused network of hospitals, serving the middle to higher income part of the society who has a very high disposable income nowadays with good insurance penetration as well in this part of the country. We currently have 4 hospitals with 561 beds. We want to grow to minimum 7 hospitals with 1,000 beds in the next couple of years.
So good, that's good. Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. Our next question is from the line of Jainil Shah from JM Financial. Please go ahead.
Yeah, thank you for the opportunity. My first question is on Agartala. We are adding radiation oncology. So what's the incremental revenue potential there? And if you can throw some more light on the arrangement with CBCC, and if there is more brownfield potential in Agartala, and how can we tap that?
Sure. So in terms of revenue potential, it can lead to a revenue upside of almost 15-odd% with the radiation oncology kicking in. We have the beds also available for the same. In terms of the CBCC tie-up, CBCC is a large US-based chain of radiation oncology setups. We have tied up with them, and they have already ordered the LINAC and the PET CT. We expect, like Anurag said earlier, the bunker and the other civil infrastructure is already ready. The medical and the surgical oncology has already started. We expect the radiation oncology also to start in the next quarter as well.
What's the revenue share that we are giving?
About 11%. And
Okay.
we will get that. We will get 11%. We're not giving that. We're getting 11%.
Okay. And, we have, two hospitals, Raipur and Ranchi, on an asset-light basis. So is there an option to purchase the hospital?
We do have a right of first refusal in case we want to purchase the hospital, but we don't anticipate it at the moment. That, I guess, will kick in only if there's some dispute amongst the developers or something. And just to answer your earlier question with respect to the brownfield opportunity in terms of Agartala, yes, there is an opportunity to add about 100-odd beds in Agartala once the occupancy, and the manager will take a call once the occupancy stabilizes around the 70 to 75% mark. And it's a low-hanging fruit, like one of the earlier callers had asked, and that can be easily done once the occupancy stabilizes around that mark.
Sure. And just one last question on, the doctors. Most of them, are on so most of the doctors are visiting consultants. So is there any plan to onboard them on a fixed payroll, or, if you could also highlight some of your strategies on the cost side?
Sure. So in terms of the doctor engagement model, it is a function of the region or the city where we are operating in. We have a higher number of full-timers in Agartala because the model of the city functions in that manner. In Calcutta, for example, there is a known trend for doctors associating themselves in a visiting manner. They don't like to be associated on a full-time basis. So we have a larger number of visiting consultants. Going forward, we know that Raipur, for example, again, has a trend for more full-time doctors where we are looking at engaging with a lot more full-timers there. So it is a function of the city where we are operating, and this is a constantly evolving strategy.
Sure. Thank you. That's all from my side.
Thank you. The next question is from the line of Dishant Jain from Quasar Capital. Please go ahead.
Yeah. Thanks for the follow-up, sir. Just wanted to ask, is it possible to quantify how much CapEx have you incurred for the oncology center at Agartala?
So we've incurred around 10 crores for the oncology setup.
And how much more are we going to incur, or is it done for us and the benefit is for the partner?
The finishing up is going on. We might incur another 1.5 to 2 crores. The rest of it would be incurred by the partner.
Okay. And how much would that be? Is it possible to?
It is not possible for us to quantify that at this point.
Okay. No, thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Amey Chalke from JM Financial. Please go ahead.
Yeah. Thank you for taking my question. The first one is on the AO list. So this is the first year, I guess, we have below 4. And some of the bigger hospitals are now reaching towards even the 3 days. So what would be the optimal AO list for us for the as a group? And what are the avenues, how you can reduce it apart from the robotic surgery? Yeah.
So the ALS coming down below 4 is a conscious call, which is a strategy which we are working on. Ideally, we would want our ALS to be around the 3.6 range on an aggregated basis. This would be different for different hospitals. Currently, our ALS reduction is more focused on Dum Dum and Salt Lake Hospital, which are almost functioning at optimum occupancy levels. Here, we are looking at reducing ALS and increasing the number of patients we can take. We are looking at getting the Dum Dum ALS from 5.2 to the 4.5 mark, which should overall help reduce the network ALS to around the 3.6 mark.
Sure. And any reason for Dum Dum having a high ALS? Is there pacemakes or something which is keeping it high?
So as stated earlier as well, the reason for the Dum-Dum ALOS being slightly higher compared to the rest of the hospitals is because of the successful renal transplant program which we run in that hospital.
Sure. Sure. And on the Agartala, we expected occupancy, which we say would be around 70% and higher after 2 or 3 years. Is it a natural course to which this occupancy will be reached, or you are taking an initiative to drive this occupancy? If you can highlight those initiatives.
It is a mix of natural course and a lot of initiatives being taken. There are multiple initiatives being taken to increase the occupancy as well, one of which is the radiation oncology setup. With radiation oncology, we expect a trickle-down effect in terms of inpatients as well across all departments. Apart from that, we've also been able to fill up some critical consultant gaps in the departments of urology and neurology. This will further add to the overall volume. Apart from that, yes, the incremental marketing work always leads to an uptick in productivity.
Sure.
The radiation oncology, once we set that up, will be the only private LINAC in the entire state.
Okay. Thank you so much for taking my question. Yeah.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you everyone for your questions. I hope we have suitably addressed the same. In case you have any further queries, please get in touch with us or through our IR advisors. Thank you for the continued support and trust in our company's vision and capabilities. Together, we look forward to achieving new milestones and creating lasting value. Thank you and have a good day.
Thank you. On behalf of JM Financial, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.